Assalamualaikum, I am Nurul Atika binti Baksani will present to you a current issue on ethics in finance, which is the collapse of Silicon Valley Bank. So, Silicon Valley Bank was established in 1893 based in Santa Clara. It banked close to 50% of all technology and life science companies fund with venture capital in the US. So, the mechanism under this current issue is first, large inflow during tech boom. Private equity firms and venture capital deposits increased from USD 65 billion in 2019 to USD 189 billion in 2021. Second is investment in long-term fixed rate deposit. SFB invests its fresh deposit in long-term fixed income securities like US government debt and US government sponsor agency mortgage-backed security, which is MBS, because interest rates were extremely low. So the problem with the current issue is first, no COR, which is Chief Risk Officer, for 8 months. The bank lacked a Chief Risk Officer, which is CRO, for part of 2022. SFB former CRO Laura Izulera departed in October, but ceased during CRO in April. So the second is unrealized losses in long-term securities. It unrealized mark-to-market loss on security held to maturity at the time were over USD 15 millions. So, how to overcome the issue? First, reinstate stronger regulatory insight. Congress enacted the Economic Growth, Regulatory Relief and Consumer Protection Act. It reformed the Dodd-Frank Act and raised the USD 50 billion stress test threshold to USD 250 billion in assets. Second is stringent risk management requirement. Implementation of interest rate risk in the banking book, which is IRRB. Basel III standards were designed. So, for the purpose of improvement, first is stringent governance and risk oversight. Effective risk management involves a sound internal control system, but the management at SFB did not put the highest premium on the critical segment. So the second purpose is enhanced stress testing. Stress testing is a theoretical stress test of credit risk, market risk, and liquidity risk to ascertain if a bank would be able to survive an economic or financial crisis with sufficient capital. So, the solution model or theory in finance regarding to this current issue is first, interest rate risk in the banking book, which is IRBB framework. Basel III guarantees a systematic method for defining capital adequacy, liquidity management, and rate of return risk. The second one is asset and liability management, which is ALM gap analysis to assess liability match model. So under this gap analysis, asset and liability management ALM refers to the management of risk created by a disparity between liabilities and assets on a financial institution balance sheet and enough capital and liquidity to meet their obligation to their stakeholders. So that's all for the part presentation from me. That's all. Thank you.